I'm about to start my new life as a mother, and I've been researching ways to secure my child's financial future. I'm wondering if I can help my child grow a $1 million portfolio and how I can go about it.
The simplest and most effective way is to actually invest in a low-cost, globally diversified index fund. So with just $200 a month, you can actually compound to a huge sum of money over the long term.
At this point, you might be asking yourself, is it really that easy? Yes, it is. The only catch is that it needs a very long investment period.
The time period of 50 years, at an annualized return of 7%, you get a total return of $1.1 million at the end of 50 years.
If you have more money you can set aside, you can reach your goal earlier.
We have a monthly contribution of around $2,000, and the time period we are looking at is around 20 years. And we are going to take a conservative estimate of 7%, and at the end of 20 years, if you contribute $2,000 a month, you will end up around $1 million. We have a 7% expected return here because the MSCI All Country World Index, a globally diversified index, has returned around 8 to 10% over the long term. So taking a 7% conservative return, expected return, it's quite doable over the long run.
A low-cost index fund is a type of fund that aims to replicate the performance of an index. Such funds tend to offer investors lower costs and taxes.
This strategy gives you the highest probability of success because it's evidence-based and it's non-forecasting. You don't handpick certain teams or sectors or geographies. You basically own the whole economy. So it gives you diversification. You don't have to stress over which country is going to do well, which country is not going to do well. So you don't have to predict the trends. You just have to stick to a disciplined way of investing monthly into a low-cost ETF that tracks a global market index.
Starting early unleashes another secret weapon for your child.
Looking at the chart here, the blue bars show you the monthly contribution, and the green bars show you the interest earned along the way. So as you can see, the blue bars are actually quite consistent with a bit of increase because the total contributions are going to increase over the 50 years. But the green bars are growing at an exponential rate over the long term. So this is the power of compounding. So what happens is, at the start, your interest is very little because the money is also very little. But as time goes on, the interest earned is on top of the previous interest and contribution, and that increases exponentially over the long term.
When you have a long runway, it also pays off to do research on lower cost investments.
So for a lot of investors in Singapore, we like to invest into actively managed funds or ETFs, but these typically can charge very high fees. A lot of active unit trusts, for example, charge 1.5%, and this is an annual expense ratio. So for example, if you invested $10,000 at 1.5%, every year in fees, they're going to take away $150. Now that doesn't matter so much on a small base of capital, but just like the whole concept of compounding your wealth, fees also compound. If you get to $1 million and you're still paying 1.5%, you're going to be paying $15,000 in fees every year, not just as a one-off, every year. This is why low-cost ETFs make a lot more sense. $10,000 at 0.1%, which you can actually even get cheaper than 0.1%, but I think that's a good base. You're going to be paying $10 in fees. Once you get to 1 million at 0.1% in an annual expense ratio, you're going to be paying $1,000 in annual fees, and that is 1/15 the price of an active unit trust or an actively managed fund.
It's also important to take note of the fund's tracking error, which can have an impact on your returns.
By investing in an ETF, the fund managers want to replicate as closely as possible to the index, but this is not always possible, and in that case, there will be some tracking errors coming in. So investors need to make sure the tracking error is as low as possible, close to less than 0.5% if possible. Yep. So that's a ballpark figure, but the lower the tracking error, the better it is for the investor because this means that the ETF is tracking as closely to the index as possible.
You should also pay attention to the fund's assets under management, or AUM. It's a key indicator of the fund's stability and liquidity.
Go with one of the reputable large managers that has a track record for producing really good ETF solutions. Want to be really in an ETF that has a AUM over $1 billion, at least US dollars, because just like active unit trusts or active mutual funds, a lot of ETFs will start on a really cool theme, and then they'll see a lot of outflows, and then they'll eventually close. They'll actually close down the ETF. So you don't want the ETF that you're investing into to eventually close down and return your money. You want to continue to compound it. And these large index ETFs, low-cost options, they have tens of billions of dollars in AUM. And so typically they are good options for investors.
Although ETFs provide diversification, they are still subject to market risk. So the advice is to take a long-term view and try to ride out downturns.
In terms of the actual asset allocation, if you want to get to $1 million, investors don't really have a choice but to invest into global stocks. There's no other alternative asset that can really get you there with the risk or the commensurate risk that you need to take. And so I think there are going to be periods. There could be lulls of maybe a year, maybe 3 years, maybe 5 years, and in some cases in the 70s, a decade, where not much happens and it doesn't move much. But over 20 years, 25, 30 years, historically, stocks have performed the best. So I think it's just keeping grounded about being realistic about those expectations, and just understanding the risks that you're taking on when you invest into stocks.
And someone who doesn't have a high risk tolerance can consider adding bonds to the mix on top of the stock portfolio. So for example, 60% index fund ETF portfolio, and then adding on bonds to the mix as well to make it a 100% allocation. So that would give a more cushion to the portfolio in terms of volatility.
Parents in Singapore can also consider topping up their child's CPF special account. These returns are guaranteed, but they do come with some timeline trade-offs.
CPF special account, which gives 4 to 5% returns per annum guaranteed by the government. One downside of this is that CPF is you can't really take it out as and when you want. So there's a limit to that. So that's something that investors have to consider when they use this CPF as a contribution tool. Another thing is that because the returns will be lower in this portfolio mix with using bonds or CPF, the time horizon is also going to lengthen. So let's say we were talking about a 100% equity portfolio. Over 50 years, you can get to $1 million if you contribute $200 per month at 7% per annum returns. But the return is going to go down if you are adding bonds to the mix, or even CPF to the mix. So because the returns are going to go down, your time horizon will lengthen as well to achieve the same goal.
With inflation, your future $1 million will buy less than $1 million today. But money that is not invested also loses value over time.
I think you need to break it down into percentages and understand you have a set goal for your children. It doesn't necessarily need to be $1 million, right? I think that's just a number that's out there. But if you have a set goal for them, that you know what the number is on a monthly basis, but break it down into a percentage of your take-home pay or after-tax pay. And along the way, there's no rule that says you can't contribute it when you get a bonus or you come into some money and just put an extra whatever amount into the market at that point in time when you do come into either a bonus or a lot of capital at one time. And so I think that's a good way to think about it, because obviously allocating a certain portion of your bonus to it, a percentage of it could be like 5%, 10% or less, that will accelerate the compounding process over time.
So after researching the options, I think the low-cost index fund and CPF are what I would be most comfortable with as someone who is risk-averse. But that means I'll have to start early so I can give my child the best possible head start.